Okay, today let's talk about futures. So we basically discussed options, which is a uh, type of future, sorry, which is a type of derivatives. And futures is the second type of derivatives we want to talk about. And you can see here that this whole lecture on futures is based on chapter 22 and 23. So whenever you find you're unclear about something in the lecture note, you can just check your textbook. First, let's start with futures basics. So first, the definition. What is a futures contract? Well, it is the obligation to make or take delivery of the underlying asset at a predetermined price on a predetermined date. So clearly here you can see that we have several important elements in this definition, right? The first, it is always a obligation. This is different from an option. We know that if you're taking a long position in the options contract, then you don't have a obligation. You have the right. And if you're taking a short position in the options contract, then you have the obligation. So you can see that this is one difference between futures contract and options contract. And then this predetermined price is called futures price. So analogously, in the context of options contract, this predetermined price is the exercise price, right? But in the world of futures, we call this predetermined price as futures price. And then the delivery would happen on a predetermined date. So it's delivery date. So you can see that in the world of options, then this kind of predetermined date is called expiration date, right? In the world of bond, this is called maturity date. So you can see that maturity date, delivery date, and the expiration date, they are all about this so-called predetermined date. And then in an options contract, you can see that it's a contract, right? So you have two parties. So if this is a contract, you would have two parties signing contract with each other. And then there is this long position and there is this short position. So we know that from the options contract, we know that if you're taking the long position, it means that you will buy this underlying asset. So in the context of futures contract, it's the same. If you take a long position in a futures contract, then you would commit to buy the underlying asset on the delivery date. So long position means you have to buy. And of course, if you're taking short position, it means that you will commit to sell this underlying asset on the delivery date. So you will sell. And since both long position and short position imply obligation to buy and sell, so you will basically commit to buy and commit to sell. Now let's look at this example, this futures contract. So this is a contract on a type of commodity which is copper. Right? Actually, I think it's a high grade copper. CMX. I actually don't know what does CMX mean. I think it's possibly it's. Let me check. I think it's Chicago Merchandise Exchange. I could be wrong. Anyway, let's first ignore this CMX part. So this is a futures contract on copper. And then you can see the contract size. So it's 25,000 pounds. This means per one contract, right? For one contract, if you're taking a long position, then you will commit to buy 25,000 pounds. Of course, if you're taking short position, then you have to commit to sell 25,000 pounds. So let's read this table and see what are these numbers mean here. So let's see this. July. Well, it means the maturity, the delivery will happen in July. This is the open price. Right? So basically it means that when the trading starts, it would open at a price of 2.229. And then this is daily high price. This is daily lowest price. This is the settlement price. So settlement price is actually pretty much the same as the closed price. However, in the world of futures contract, we don't use closed price. We use settlement price. Settlement price. And settlement price is a representative trading price during the last few minutes of the trading. So you can see that by definition, this is equivalent to a closed price. And the change, right? So this number, it basically means the settlement price today has decreased by this amount compared with the previous trading day's settlement price. So essentially, the change means today's settlement price minus yesterday's settlement price. Open interest. So we talked about this guy when we were discussing options contract. Open interest basically measures how many outstanding contract, that is, contract that has not been closed. Okay. So in the financial market, we have a lot of different types of contracts. So you can see that we can basically categorize these types into so 5 categories. Right? So the first one is about the foreign currency. It's like if you want to use futures contract to bet the exchange rate between Canadian dollars and US dollars, then you could buy this futures on Canadian dollars. So the second type is the agricultural, right? Corn, oats, soybeans, and other different types of agricultural commodities. The third type is metals and energy. The famous one would be crude oil, right? And because we live in Winnipeg, what's the famous futures contract? It's canola. Right? Then the fourth type is the interest rate futures. So you have to bet on what is the interest rate. Equity index. So the futures equity index, I think potentially they are maybe they are the most familiar type of futures to retail investors. For example, if you want to invest in this S&P 500 index, then one way to invest in this S&P 500 is to buy a ETF. And another way is you could use this futures contract on S&P 500. So the futures contract on S&P 500 is called E-mini. And it is a very liquid, popular type of futures contract. Okay, Now let's talk about the profits you can make from futures contract. If you're taking a long position, then your profit would be the market price minus the original futures price. But in the world of futures, we don't use market price. Instead, we call the market price as the spot price. So basically, you can see that it's just a different terminology. In the when we learned about options contract, we actually use the market price, right? But here we use spot price. And you can see that if you're taking the opposite position, that is, if you're taking a short position, then obviously your profit would be the negative of the long position's profit, right? So it would be the original futures price minus the spot price at maturity. And from the formula here, you can see that a futures contract is a zero-sum game, right? Which means profit to long plus profit to short equals zero, right? So that's the definition of zero-sum game. That is, the sum of two parties' gains and losses would be just a zero. It's a zero-sum game. Okay, now let's see this example and learn how to calculate profit and losses from futures contract positions. So again, we're looking at the same table, right? We're looking at the same the same futures contract on this high copper. So let's say we suppose when the contract matures, the price of copper is 2.5 pounds. Now let's calculate the profit to the long position and the profit to the short position. So if you're taking a long position, then your profit would be spot minus the initial futures price. So let's say this is your initial futures price. So you bought or you entered into this future contract at this settlement price. And you can see that this 2.5 and 2.1815, they're just price per pound. And for one contract, the contract size is 25,000, right? So if you enter this contract, you have to take the delivery of 25,000 pounds. So in this case, this would be your profit, which is 7962.5. So if you're on the short side of the contract, then your profit would be the initial contract price minus spot price times the size of the contract. So this gives you minus 79.5. Again, you can see that the loss has to be the same as the gain, and they will offset each other. So the sum would be zero-sum game. Okay, let's look at the graph of the profits for futures contract, and we could compare the profits from futures contract with profits from the options contract. So what you can see here is essentially in terms of formula, right? If you're taking a long position, futures contract equals PT minus F0. What is PT? P refers to price. So here, specifically, PT is the spot price on the delivery date. In this lecture, we always use the capital T to refer to the delivery date. And of course, 0 means the initial date. So here F refers to futures price. So you can see that P capital T refers to the spot price on the delivery date, and F0 refers to the futures price on the initial date. And now you can see that you could basically use a formula to calculate the long position's profit, right? So it's spot price minus F0. And then you could draw out the relationship between profit and PT, spot price, right? So you can see that this has to be a straight line with a slope of 45 degrees. And you can also see that if PT equals F0, then profit has to be 0. So this could quickly gives you a line on the like this, right? And again, we know that for short position, then the short position's profit has to be the negative of the long position's profit. So if the long position has an upward sloping 45 degree straight line, then would have a downward sloping 45 degree line, right? So this gotta be the short position's future profit. And then let's look at graph C here. So this is a payoff and profit to a long position in the call option. Of course, you can see that this X refers to exercise price. Right? And we know that in terms of payoff, if the market price is smaller than exercise price, then the payoff from the call would be 0. And after that, we will get this upward sloping 45 degree straight line, right? And then because if you want to enter a call position, you have to pay some premium to buy this call. So your profit would be a little smaller compared with your payoff, right? So the distance is essentially your premium. Right? Now, what can you learn from these three different pictures? Well, there are at least 2 lessons you can see here. The first is you don't need to pay a premium to enter a long position, right? So compared with option contract, this is different. In the option contract, if you're taking a long position, you have to pay money for it. In the futures contract, you just sign the contract. You just enter this contract. There's no cost to enter a futures contract. So this basically means that if you're on the short side of the futures contract, you will also not get any premium, right? So this is different from options, because in options, if you're the seller of an option, you will get some money, right? Because the buyer of the option has to pay the option's premium to you. And then a second lesson, which is pretty important, even if you're a retail investor. If you compare the the picture C and the picture A, that is this picture with this picture. What you can see here is when you're taking a long position in a call, then you're pretty much protected, right? Which means the worst case, your payoff is 0. Now, what about when you're taking a long position in futures profit? It's not, right? So there is no downside protection here. You can see that this line can actually continue to extend, right? And you can see that your maximum loss is minus F0, right? So this gives you the idea that if you're taking a long position in the futures contract, there's no downside protection and you can actually lose a lot of money. The reason is quite simple, right? Because when you're taking a long position in the options contract, you have the right. So you don't need to exercise your contract if you find out it's not profitable to do so. However, in a futures contract, both parties have obligations. So this means if you're taking a long position, you have to buy it, right? Even if buying it will generate a negative payoff. So that's why there's no downside protection in futures contract. It's because it's your obligation, not your right. Okay, now let's look at the second topic, which is called trading mechanics. So we basically want to learn how futures market works. Right? So on the surface, if you imagine how a futures contract is signed, you might imagine that a buyer and a seller, it's not good to use buyer and seller in the futures contract chapter. So you might imagine that two people, they would in some form contact with each other, and one would enter the long position and the other would enter the short position. And on this delivery day, the person entering in this long position would give money to the person in this short position. And then the person in the short position will make delivery to the person in the long position. Well, in reality, the long position and short position will not transact with each other directly. There is always a middleman here, right? Which is a clearinghouse. So when you're establishing this long position, you will not directly interact with the investor who is establishing this short position. You will actually interact with this clearinghouse. That is, you will give money to this clearinghouse on this delivery day, and clearinghouse will be responsible for delivering the commodity to you. And then you could also look at this right hand side, right? So basically you can see that the short position will interact with this clearinghouse. The clearinghouse will transfer the money to the short position, and short position will make the delivery to the clearinghouse. Okay. Now, how do you close out your position? Let's say you have a long position in the futures contract on SP 500. And after 10 days, before its delivery date, you want to exit your position. How could you do it? Well, what you will do is you will enter the opposite side of this contract. That is, if you have entered the long position, to exit your long position, you will enter the short side of the contract. So you will enter the short position. By the same reasoning, if you have entered a short position, then to exit your position, you will enter the long position. Right? So it's actually a pretty easy to understand idea, right? It's like if long position means +1, short position means -1, right? So 1 minus 1 equals 0. So in the end, your net position is 0. Okay, so in reality, most futures contracts are closed out by reverse and trade, and only 1 to 3% of contracts will actually result in this actual delivery of these underlying assets. So what is your total profit if you exit your position before delivery date, right? So your profit will be given by the changes in the futures price. For example, if you enter your long position with the future price of F0, let's say after 10 days at time T, you want to exit your long position and you enter the short side of the contract with a futures price of FT. So in this case, you can see that your profit would be given by the difference of these two futures prices. Of course, we learned it's a zero-sum game. So if you're on the short side, then your profit would be given by the initial futures price minus the future price at the future price at or on the day when you exited your position. Okay, now let's talk about margin trading. Right? Obviously, we learned about this. That is, in equity trading, we learned you can do margin trading. Right? So let me remind you, when do you or what is margin trading, right? So basically, if you're very bullish with the market, then let's say you want to borrow some money to buy some shares. In this case, you're doing this margin trading. And then the second scenario is when you're short sell. When you're doing a short sell, then in this case, you have to post the margin, right? Now, in the world of futures, you have to post the margin. First, let's define initial margin. Again, this is pretty simple because we have defined this in the equity chapter. So initial margin refers to the percentage of the purchase that must be covered by your own money or some other collaterals. Maintenance margin is the minimum amount of equity or shareholders' equity you have to maintain after the purchase. Margin call, it basically means when the maintenance margin is reached, broker will call you, ask for additional money. Now, the fourth concept is new and unique and very important. It is unique to futures trading. Marking to market. Essentially, it means that each day, the profits or losses from the new future prices will be realized, and it has to be paid. And these profits or losses will be paid or will be deducted from your account. I know at this time, this concept of marking to market looks ambiguous, but trust me, once you see the example, you will see that it's actually very easy to understand. Okay, now let's see example here. Okay, same table, right? Same table we have seen for several times. So let's say the initial required margin is 10%, right? So it's 10%. Now let's say you wanted to buy just one contract. So if you enter this one contract, you would know that the size of the contract would be 25,000 pounds. And what is your futures price? Let's say the future price is the same as the settlement price. So the total value of your position would be the size of the contract times the price per pound. So this is 54,537.5. Now let's say the initial required margin, the initial margin is 10%. Now this is easy, right? It basically means you have to have this amount of money. in your trading account. Okay, now let's look at this market to market arrangement. So let's say after 1 day, right, the future price increases from 2.1815, that is this price, to 2.1915. Now, clearly you can see that this is a very small increase. That is 0.01 per pound. Sorry, yes, 0.01 per pound. And in this case, if you're taking a long position, you will get this 1 day profit. And this 1 day profit will be added to your account. What is the 1 day profit? Well, you have, for one contract, you have 25,000 pounds. And per pound increase is 1 cent. So it's 25,000 times the per pound increase. So it's $250. So it means that on that day, you will get this money. Clearly, if you're taking short position, then on this day, after the settlement price has been determined, then your account will be deducted this $250. Okay, now let's see this example. It will gives you a even more clear idea on how this market to market works. Okay, so we assume the 5-day maturity futures price for silver is this. And now over the next 5 days, right, the future prices are given by these numbers. Now, let's say for one contract, the size would be 5,000 ounces. So calculate the daily market to market settlements for each contract held by the long position. Okay, so you entered this contract at this price. Now, after 1 day, its price increases to 20.2. So let's say you're entering. Oh, the question is about the settlements for the long position. So let's just look at the long position. Okay. Remember that if you're having a long position in the futures contract, then the profit is given by FT minus F0, right? So essentially it means after the first day, the profit is 20.20 minus 20.10. However, this is just profit per ounce, and you have 5,000 ounces. So you have you have to time this amount with 5,000, right? So this gives you, let me see, I think it's $500. So this means after the first day, your account will increase by $500. And now let's continue to do this exercise. And after 2 days, or at the end of the day 2, it would be right, so it's 0.05 times 5,000. It's gotta be 250. And then you can see that from day 2 to day 3, there is a decrease in the futures price. So if you're taking the long position, you have to suffer from this loss, which is minus 0.07 times 5,000. So your account would be deducted $350. and then there's no change. So your account balance would stay the same. On the last day, right, this maturity date, it would be, so increases by 3 cents. So it's this times 5,000, which gives you 150. And now you can see that these numbers are just daily changes, right? So you can look at the accumulated changes. You would basically add up these numbers. So this would give you, I think it's just 500. Right? So this means that holding your futures contract for 5 days, your account balance would increase by 500. And clearly you can see that the account balance is adjusted on a daily basis. Okay, that's great. Okay, next, convergence property. So this is the result, which tells you that on this delivery date, the future price and the spot price must converge. That is FT, which is the future price on the delivery date, has to be equal to PT, which is the spot price on the delivery date. Clearly you can see this by using this no arbitrage argument, right? So you can assume if FT is larger than PT, what can you do? Well, you will enter a short position in this futures contract. And short position means you will have to deliver this commodity. And you can just buy this commodity at a lower market price and then deliver it. So you will get a positive profit. And you can also see that if the opposite happens, so if the futures price is smaller than this market price, then you will take a long position, and then you will receive the delivery of this commodity. Then you could sell at at this higher market price, so you will get a positive profit, right? And then you can see that in a world without arbitrage, these things cannot happen. So FT has to be the same as PT. Clearly, you can see that the profit to the long position on the delivery date is given by the futures price on the delivery date minus your initial futures price. However, we have learned this convergence property. So FT has to be the same as PT. So the profit to the long position can be written as PT minus F0, right? Obviously, this is a pretty simple result. You can verify this. So let's calculate your total profit. So here we are essentially using this more complicated process, right? So we're thinking about this market to market, and we're trying to calculate each day's account balance change, and then we will add up these changes to get the total profit. But you can see that this formula tells you, well, you could just use this final futures price minus the initial futures price, right? So it would be 20.21 minus the initial futures price times the contract size. So this would quickly give you the answer, which is $500. Okay, last, let's talk about settlement. So when we first define futures contract, we used the word delivery, right? Take delivery, make delivery, delivery date, So it basically means that, at least originally, if you're in this long position of this futures contract, you will have to take the delivery. And if you're in a short position, you will have to make the delivery, right? And nowadays, still there are some futures contract which requires actual delivery. For example, the Canada futures and Winnipeg Commodity Exchange. So in this case, you have to, if you're in a short position, you have to deliver canola to this long position. Sometimes people would joke about this. They would say, hey, if you take a long position in this canola futures, then overnight after you wake up, you will see 2 tons of canolas lying in your front yard. This is impossible. What will happen is generally there would be some sort of storage units, and then this person in the short position will just transfer the canola stored in that in that unit to you, right? So no delivery would be made in your front yard. So don't worry about that. And then the second case, which is like more common these days, is cash settlement. So the investor, the person, the firm in the short position will basically transfer the associated cash position to you. So for example, the E-mini SP500 index contract, that is the futures contract on the SP500 index, it calls for the delivery of 50 times the value of the index. So suppose at the maturity, the SP500 is at a level of 2000. Then if this futures contract uses cash settlement, then it means that the short trader will have to deliver 50 times 2000, right? A total of 100,000 to the trader in the long position. Okay, now let's talk about trading strategies. So basically in the futures market, just like in the options market, we have 2 kinds of traders, right? The first type is this speculator. The second type is hedgers. So speculators basically means that you're trying to speculate, you're trying to make money. So you're trying to profit from price movement. So if you think the price of the commodity will increase, then you will take a long position. If you think the price of the commodity will decrease, then you will take a short position. It's like so the analogy in the options market is, if you wanted to speculate, and let's say you believe the price will increase, then you will buy a call. If you believe the price will decrease, you will buy a put. And then we also have hedgers in the futures market. So actually, I think a really important function of the futures market is about hedging. So we know that if you're a hedger, what you're trying to look for is you're trying to look for protection from price movement, right? So basically, you wanted to hedge against a certain price risk. So in the world of hedgers, we could have long hedgers and short hedgers. So long hedgers means you're taking a long position in the futures contract. Short hedger means you're taking a short position in the futures contract. So why do you want to take a long position in the futures contract to hedge against price movement? Well, just think about this, right? Let's say you're a a coffee shop, right? And you expect, or you're afraid, you worried the price of coffee beans would actually increase in the next year. So what you can do is you can enter a long position in the futures contract, and then you can lock in your purchase price, right? Because you know that next year when you want to buy coffee beans, you will just pay the futures price, right? So basically you can see that the motivation of long hedge is you want to protect against a rise in purchase price. Now what about short hedge? Let's say you're a farmer and you want to sell coffee beans, but you're worried maybe next year the price of coffee beans will be lower. So what you can do is you could enter the short position of a futures contract. And then you would know that next year when you're selling your coffee beans, you will sell at a predetermined price, which is the futures price, right? So the motivation of short hedge is you're a seller and you want to protect against a fall in selling price, right? Okay, let me summarize, right? So if you're a buyer and if you're worried about a potential price increase in the future, then you could use the long hedge by entering a long position in the futures contract. And if you're a seller and you're worried about a decrease in your selling price, then you could use short hedge by entering the short position in the futures contract. Okay, now let's learn about the speculation and the hedging through examples. And the first example is about a person tries to speculate. Okay. So let's say the initial margin requirement for the oil contract is 10%, and then the current future price is 52 per barrel, and the contract size is 1,000 per contract, and you have $5,200 in your trading account. Now first, do you need to add money to satisfy the margin requirement? Well, this should be easy, right? You guys have done like several times of this type of question, right? So let's say you want to buy one contract, and one contract means 1,000 barrels. So the total value of your contract would be 1,000 times 52, because the price is $52 per barrel. And the initial margin requirement would be 10%, so times 10%. So this is the minimum amount of money you need to have in your account to enter this futures contract. And you have just this exact amount of money, which means you don't need to add money, right? So you don't need to. Now, if the futures price increases by $1, what is your return? Well, this is really simple, right? Because you have $1. Because you have one contract, so you have 1,000 barrels, and per barrel increase would be $1. So the total profit of your account would be $1,000. So your return would be 1,000 divided by your initial investment, which gives you 19.2%. Okay, let's examine the second question. First, you can see that the the change in the oil price is actually quite small, right? Because the future price is 52. And let's say on the second day, the future price increases to 53. Now, what's the change? So the change is 1 divided by 52, which is 1.92. Now let's compare these two numbers. You can see that per barrel futures price increases by only 1.92%, but your account increases by 19.2%. Right? So you can see that it's exactly 10 times. Right? Why do you get this 10 times here? The reason is because you have this 10% margin. Now let me give you a general formula, right? So let's assume margin requirement is M, right? So let's assume the total value of your contract is V. Now, if the margin requirement is M, it means that your account have to have this amount of money, right? M times V. Now, let's say the future prices, right, increases by some amount, and this will gives you a return of R. Right? So let's say you will have a return of R because of the future price change. Now you can see that the return of your account you know what? The name is just too long. So this is your return. Okay, let me again tell you these notations. R is the return from the future price. And V is the total value of the contract, and M is the margin requirement. So you can see that these two V's would just cancel with each other. So this gives you R divided by M. And in our example, you can see that the R equals 1.92%, right? So this is the return from the future price change. That is, the original price was 52, and now the futures price increases by $1. What is M? M is the initial margin requirement, so it's 10%. So this gives you 19.2%. What's your feeling about this? It basically means that because of this, well, because for futures you can use margin, this kind of like a leveraged position, right? Because we have learned if you're using leverage in your position, then the return will be magnified. Of course, the loss will also be magnified. So you can see that when you're using margin in your futures contract, it is equivalent to say this futures position has some embedded leverage. Okay, I think that's for this problem. Okay, now let's look at this second example. This is an example about hedging. Okay, now let's say a oil producer, and it wants to sell 10,000 barrels of oil in February, and it wants to hedge against price risk using futures. To be more specific, it will want to sell 1,000 contracts. Of course, the contract size is 1,000 barrels per contract at the futures price of $52, which matures in February. The possible prices in future, the possible prices in future are 51, 52, 53 per barrel, and show that the revenue from the sales is independent from price movement. If you look at this problem, you could just very intuitively say that, well, I have sold a contract with a futures price of 52. This basically means that when I make delivery of these 100,000 barrels of oil, I will definitely sell at the futures price of 52. So this answer is actually, I would say, conceptually correct, but in reality, it's not that simple. So let's see how this actually works. Let me write down these prices here. Note here you have actually two different positions in your portfolio, right? You have oil and you have a short position in futures. So you're taking a short position. If the price of the oil is $51, then the value of your oil would be worth 51. Okay, this is a large number. Let's see, 51,000. Right? Of course, for all other cases, it's very simple to figure out the value of your oil. So 50. Okay. Now, what about the futures? Well, we know that if you're taking a short position in futures, your profit would be given by F0 minus PT. That is your initial futures price minus the final date spot price on this delivery date. So here, if it's 51, then you can see that it would be, you will get a profit, right? So it's, let me see, what is the, okay, so it's 52 minus 51 times this amount, right? So it's $100,000. If it's 52, then it's just a zero. If it's 53, then it would be minus $100,000. So what is your final account value? So it's always it's always $5.2 million. Okay, so it's always this amount. Right? So let's see what is exactly happening here. So you can see that basically on this delivery day, what will happen is you will sell your oil at the market price, even if you have a future price of 52, right? So here you're selling your oil at spot price. That is, if the market price is 51, when you deliver your oil, you will sell at the market price. However, you can see that because you have the short position in a futures contract, your futures contract will generate these payoffs from this marking to market, right? And by the same reasoning, if, or in the third case, you have to lose this $100,000 from this making to market, right? So in the end, the gain from the oil and the loss from the futures will just offset each other if the price is 53. Or you could say the loss from the oil position and the gain from the futures contract position will offset with each other if the market price turns out to be 51. Okay, we can see this from this nice picture here. So you can see that first we have two blue lines, right? So the top blue line is the line for sales revenue from your oil position. Then the lower blue line is the profit from your futures position. So what you can see here is, obviously, if oil price is higher, then your sales revenue from your oil position will be higher. So you have this upward sloping line, right? So this is upward sloping. And then for this lower part, for this curve, well, because you're having a short position in futures contract, so if the oil price is higher, then your profit on the short position in futures will be lower. So you have a downward line here. And then what you can see here is, well, the total revenue is essentially the sales revenue from oil price and the profit from the futures position, right? So we can see that if you add up these two lines, then you can see that the loss and gains will offset with each other. So in the end, you will have this dashed black line, which is horizontal, which means the hedged revenues are always constant at $50. So basically you can see the motivation here, right? If you're the seller, you wanted to, or you want this certainty. You want to know that for certain in the next year, February, you can sell your oil at $52. So as a hedger, you will want to do this. That is, sell this futures contract with a futures price of 52. Okay, now let's talk about another concept, which is basis and basis risk. So first, let me define basis. So basis is the difference between the futures price and spot price. So we have this notation T here, right? It's not this capital T. We're just using this lowercase t. So essentially you can see our convention of notation here. If I draw this timeline here, then this 0 basically means this initial date. So initial date when you first enter this futures contract. This capital T means this maturity or delivery date. So this is the date when your contract expires. And then this lowercase t means any date between the initial date and delivery date, right? So it's a date in the middle. And then basis is defined by two prices. That is the futures price on this day in the middle and the spot price on this day in the middle, right? So the definition is very simple. Now, what is the motivation for this definition? Why do we define this? Well, the underlying motivation for such a definition is at time t, that is at this time t, the the futures price ft and the spot price pt, it's possible they're not the same. So the difference is called basis. And you can see that on this delivery date, ft always equals pt, right? Because we have learned this convergence property. Right? So basis has to be 0 on this delivery date. However, you can see that if it is not on the delivery date, then the basis could be non-zero. And because of this existence of basis, from a hedger's perspective, there is this basis risk. So let's start with this hedger we just talked about. That is this guy here. We know that this guy, by using this hedging technique, in the end, he would always get this fixed revenue, right? The number is fixed. So you can see that there is no risk, because in the end, the total revenue is always the same. Well, the reason is because on this delivery date, the futures price and spot price, they are equal. So the gains and the losses on the futures and the commodity position will exactly offset. And you can see this result here. You can see that if the price is 51, then you can see the futures position, right? It will gain $100,000, and on this commodity position, compared with $52 price, it will lose $100,000. And then you can see that this positive $100,000 and negative $100,000 will offset with each other. So in the end, you will get this fixed amount. Then the same thing when the market price turns out to be $53. In this case, you will lose $100,000. But compared with this futures price, you will gain $100,000. So again, the gain in the commodity position and the loss in this futures position will offset with each other. So you will again get this constant payoff. You can do this, it's really because on this delivery date, the basis is 0. And now you can see that it could be problematic if the basis is not 0. That is, if you wanted to liquidate your position before delivery date. That is, if you exit your position of futures contract on this date T, there's no basis risk because basis is always 0. But if you want to exit your position before this delivery date, let's say if you want to do it here, then you will have this basis risk. The reason is because if the basis is not 0, then the future price and the spot price, they're not equal. And the gains and losses on the contract and the commodity position will fail to offset with each other. Now let's see an example and see how a speculator can actually profit from the moments in the basis. So let's see this. Let's say there's a speculator who holds 100 ounces of gold, and he sells one gold futures contract. So let's say today gold sells for $1,391 per ounce, and the futures price for June delivery is 1369. Now you can see that there is basis, right? So basis equals future price minus spot price. So it's 1396 minus 1391. This gives us 5. And let's say tomorrow the spot price increases to 1395 and the futures price increases to 1399. So the basis would be 1399 minus 1395, which is 4. So what you can see here is basis decreases from 5 to 4. Now let's see how this person can profit from the narrowing of the basis. So the question asks about the speculator's profit. Well, it's actually very easy to see what is his profit, right? So this speculator basically has two positions. The first one is the commodity position. The second one is the futures position, right? So the profit from his commodity position is 1395 minus 1391, right? So this is the profit from the commodity position. And what is the profit from the futures position? We know that the initial futures price was 1396, and then the future price increased. So his profit would be 1396, that is the initial futures price minus the second day's futures price. So this gives us, sorry, I should use 1 here. So this gives us, so this is 4, this is minus 3, so it's 1, right? So per ounce, this speculator will earn $1. Interestingly, you can see that this $1 comes from the narrowing of this basis. So basis decreases from 5 to 4, right? So this exactly equal to 5 minus 4. So the result here is if you expect the basis to be narrower, then you should use a long spot short futures position. Long spot means you will actually buy this commodity. Short futures, of course, it means that you will enter the short side of the futures contract. And if you expect the basis to become larger, then you will want to use a short spot in the long futures position. That is, you will short sell this commodity and you will take a long position in the futures contract. Okay, that's for today's class.